Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. We've got a lot of important things to go over. Going to start off of the show with the big brokerage firms are fighting for your investment accounts. Normally, that's a good thing because competition. This isn't so good. We'll talk about what's going on there. And can Travis Kelce turn six flags around? That's a very interesting story. We'll discuss that. And then also to markets. Well, you expect when the Fed does a rate cut, you'd expect the markets to increase. Well, markets declined after the Fed rate cut. We'll talk about why that is. And with me is Chase Wilsey. Chase, what companies are we covering today?
Yeah, the companies we're going to look at. We're going to start off with Coca-Cola. Then we're going to look at Capital One, Qualcomm, nice San Diego-based company here. And then also Knight Swift Transportation. Could be a good read maybe on the underlying economy. So we've got a full slate of companies here, different industries, different types of businesses. So excited to break down those fundamentals, give you an idea if we think it's a buy, sell, or hold based off the numbers we see here today.
Well, let's dive right into markets actually declined after the Fed rate cuts on Wednesday. The Fed announced they would lower the benchmark overnight borrowing rate by 0.25% to a range of 3.75 to 4%. Now, this marked the second consecutive cut of 0.25%, and there's still one more meeting left this year where we could see another rate cut. The keyword here is could, and the lack of conviction around another cut is likely that what spooked the market. Got him really kind of scared there. Powell said a December rate cut. Well, he said it isn't a foregone conclusion. And while recently appointed Fed Governor Stephen Moran again dissented in favor of a 0.5% cut, well, there was on the other side the hawkish dissent with Kansas City Fed President Jeffrey Schmidt, who voted for no decrease at all.
There was also, I saw, I think her name is Lori Logan. I think she's the Dallas Fed president. She's not a voting member, but she will be a voting member in 2026. Wow. She came out this past week and also said, I wouldn't have cut.
Right.
So she, again, didn't get that dissent vote because she wasn't voting. But again, there is kind of a little bit more rift in the Fed.
You know, and that's an interesting point because I forget the numbers, but I know the board of governors, I think it's like 12 or 14 members. But
14.
14. But then around them, there's like, I don't know, 15 or 20 more that they're not voting, but they still have input. And I don't know how it exactly works, but I'm sure they have some influence.
Gosh, we did a post on that probably about a year or two ago. We might need to pull that back up because it is so interesting, right? Like the Fed that is voting today, you have your permanent voters and your rotating voters. It could be a totally different set of minds that comes in next year, and you don't really know how they're going to vote until they're in that seat. So, I mean, it'll be interesting to watch. And, you know, obviously we got that one dissent from Mr., I think I'm going to say Schmid. It's got the D, the hard D. So I'm going to go with Schmid.
Good.
His vote and then Powell's language, again, is what likely sent the market lower after the announcement, as many essentially had that December rate cut factored in as a sure thing. Powell also added that there is a growing chorus, kind of as I was saying here, among there you go, 19 Fed officials. Not all of them vote. There's 19 Fed officials, though, to at least wait a cycle before cutting again. This resulted in traders lowering the odds for a December cut to 67% from 90% the day prior. So that is, again, I think what spooked things. And I actually pulled what Mr. Schmid said here in a statement. He said, equity markets are near record highs, corporate bond spreads are very narrow, and high-yield bond issuance is high. None of this suggests that financial conditions are particularly tight or that the stance of policy is restrictive. In the end, inflation is the Federal Reserve's responsibility and within its control, and as I balance the mandate and the effectiveness of the Fed's actions in meeting that mandate, my preference was to hold the policy rate steady at this week's meeting. I'd have to agree with those statements.
Yeah.
I mean, you don't have necessarily maybe inflation being as problematic, but you have asset inflation that I think you got to factor that into the equation as well.
And I do worry that Powell is feeling the pressure from the president and not being independent and saying, yes, we'll reduce them, because I don't see why we're doing this, to be frank. And economy's going along. I just get so afraid of you shooting all your bullets, and then when you need them, oh gosh, we got none left. I'm afraid of that.
Yeah. Well, what are we worried? Unemployment's going to go from 4% up to 4.5%. I mean, it's almost like we can't let unemployment nudge up anymore, even though we're at a historically low rate. I am again very concerned about the inflation creeping back in, and I think there has to be that balance, and that means maybe letting the labor market even deteriorate a little bit more.
And you, Harris, and I were talking earlier today that an economy has to go through cycles. You have to have your booms and busts. I'm sorry, that's the way it is. And when you try to avoid them, you're not ever going to avoid them. You're just pushing things off later, which would be a much worse situation. That's what I'm afraid is happening here. Is that we might go another year or two, but boy, there's going to be hell to pay when things actually do fall apart.
Yeah, no, I mean, there's definitely a lot of things in the underlying economy that, again, I think should warrant some concern. But if you keep kicking that can down the road, eventually you can't kick it anymore.
No.
And that's when the issue comes.
Yep. Given lack of data and an economy that still appears to be in an all right position, I do believe the Fed needs to be careful cutting too quickly, essentially, since they are taking another accommodative stance with the announcement that there would be the ending of the reduction of its asset purchases, a process known as quantitative tightening, on December 1st.
Yeah, and this is just another accommodative stance. Everybody talks about the Fed rate cuts, but the quantitative tightening, quantitative easing, it kind of happens in the background. We can talk a little bit more, but it's a much more complex system that goes on, right? The Fed cuts rates to, what do we say, 3.75%? Is that what? 3.754. That's very easy to comprehend. The quantitative tightening is much more complicated, but in theory, what it does is it stimulates the Treasury and mortgage-backed securities markets, which should help with longer dated debt instruments, as the Fed was allowing these assets to just roll off the balance sheet and now will need to step in and buy new debt to replace the securities as they mature. While QT, again, quantitative tightening, shaved off around $2.3 trillion from the Fed's balance sheet, COVID led to a major expansion from just over $4 trillion to close to $9 trillion. So yeah, we've come down, but we hit this huge increase due to COVID. And again, the way that this kind of works is the Fed owns all of these treasuries, mortgage-backed securities. And what happens, let's say they had $100 billion worth of mortgage-backed securities and treasuries maturing. Well, before, or I guess currently until December 1st, they were then repurchasing anything in excess of $35 billion in mortgage-backed securities and $5 billion in treasuries. So they were allowing that balance sheet to shrink because they weren't buying those assets. But now what's happening is they're saying we're done with quantitative tightening. So what happens when an asset matures? Well, then they go back into the market and they buy that asset to replace it on the balance sheet. So it creates, I'm going to say, that artificial demand in the Treasury and mortgage-backed security market.
Yeah, and they're now down to $6.6 trillion, nowhere near the $4 trillion when they started. And I get worried about the debt with this, and I'm going to figure out a way to try to make this, because you got the bank reserves involved. I want to try to figure out a way for our listeners, our readers, our viewers on how to understand what's going on. Because when you understand it, we talked about kicking that can down the road. That was what is happening. And again, we've talked before that, when they reduced the prime rate or the discount rate, that short term, they realize that. So now they're starting to fool around with longer term rates, which worries me by doing this quantitative tightening. So,
yeah. I mean, it is a concern. And, I was talking to Harrison at lunch here as well. And we were talking about how, pushing mortgage rates down to 3% has almost made it like a 6% mortgage is terrible. Yeah. But in reality, a 6% mortgage is not that bad.
Right.
And you can't have money at sub 3% because that's what then fuels a lot of the speculation. I think that's what could cause a lot of the issues. I mean, maybe that's why, again, you've seen your cryptos increase, you've seen your meme stock.
Oh, yeah.
You have so much money in the economy, in the system, that it allows for these speculative bubbles. And that's where I guess a lot of my concerns come.
The question is, whether rapid expansion just a few years ago was enough removed from the balance sheet to put it at a more normalized level. Like with the Fed cuts, I do believe in monetary policy easing too much. We risk a return of inflation and further increase in many speculative assets, as we're talking about here, that could cause problems down the road. It just, people do not realize some leverage is good. Over leverage is terrible, and it's going to cause problems. And you're trying to keep boosting the economy. Sometimes you just need to take a break and let things cool off a little bit. And yes, I know some people lose jobs. Yes, I know some are going to suffer. But you can't keep on with the loose money, because as you mentioned, the speculation, all these things, the higher it goes, the bigger the fall is going to be.
Yeah, I think there is, again, definitely some level of concern that people should have given, again, valuations in the market, valuations in the real estate market. Obviously I brought up cryptocurrencies. That makes no sense. I mean, there's just so many areas of overvaluation. And you listen to anybody.
Yeah.
Even people say, well, I think the market's still going to do good the next year. But, yeah, I mean, things are really expensive. How does that make any sense? And it's like, okay, so what about 3 years from now, 4 years from now? Are we still going to keep saying every single year, like, well, things are just really expensive, but, it's still going to keep going higher? At some point, valuation will matter, and that's where I guess these issues can ensue as people all of a sudden get blindsided, even though they shouldn't have been blindsided.
Right.
Right. The funny thing, right, is people are admitting that there's a problem, and they're not taking any action. So you're not even getting blindsided by the problem, I guess. You're getting slapped in the face while watching it come. It just makes no sense.
Well, and that's why they say, don't listen to what people say, watch what they do. And that's the big thing. That's true in the economy. Let's talk about something positive, because that's really pretty negative. That's why we're so conservative investing, because we are concerned about the longer term. So that's why we're not buying all the high flyers and so forth. And yes, congratulations, you made money. But again, the risk is there. And what's going to happen, Chase, is eventually going to collapse. And people can say, what happened? No one told us. They weren't listening to the Smart Investing Show. They weren't reading.
We were talking about Jamie Dimon earlier, and he's been talking about this hurricane coming for years, and people are like, oh, yeah, Jamie Dimon, he's crazy. He didn't know what was going to happen. And when he's saying stuff like that, it doesn't mean it's going to happen today, tomorrow, next month, maybe not even next year. It could happen 5 years from now. And it's about creating the system and problems in the system, and then when they unfold, it's an unknown. And then that's when the collapse occurs, and it's like, yeah, I told you 5 years ago this was going to happen.
Yeah. And no one knows when it's going to happen. You just see the situation building over time. But let's switch on to talk about Travis Kelce turn around Six Flags, and that's the entertainment, Six Flags with big roller coasters. If you're not sure who Travis Kelce is, well, he is a tight end for the Kansas City Chiefs and engaged to the well-known singer Taylor Swift. Now, Six Flags, they are a public company that trades under the symbol FUN, F-U-N, has received an investment of $200 million from the activist investment company Jana Partners. It was not disclosed how much investment Travis has of the $200 million, but he does like to invest in companies, both public and private.
And it's funny because obviously Taylor Swift is, I think she's like,
who's that now?
I think she's like a billionaire or something.
Oh, she is a billionaire. But if I don't think we have to say who she is. If anybody doesn't know who she is, and I got to admit, I do not know one song she has, but I know who she is. I don't think there's a person in America, unless they're under maybe 5 years old, does not know who Taylor Swift is.
Yeah, just Google says estimated net worth for her is between $1.6 billion to over $2.1 billion. And, Travis Kelce, I don't think is near that. I think estimated net worth is around $90 million.
Yeah.
So of the $200 million in there, his net worth's $90 million. It's maybe a couple million, unless he borrowed some money from Taylor Swift there. But when we look at Kelce, he has investments in over 30 companies that include manufacturing, distribution, consumer goods, entertainment, and a beer company. He's pretty excited about this investment because as a kid, he used to love the roller coasters, Dippin' Dots, and him and his brother, who actually also played in the NFL. I liked his brother, Jason Kelce. They had great memories at Six Flags. He even suggested that they do a roller coaster with a 300-foot drop where riders' feet dangle from beneath. And no, thank you. That is not something I am interested in. I'll tell you that right now.
Yeah.
The other thing, too, that I look at with Kelce is I'm just not a big fan of his. I don't like Taylor Swift that much. I don't like Travis Kelce just because he's on the Chiefs. He's on a different team, maybe. But, gosh, I hate the Chiefs, so I won't be going to Six Flags.
And his brother he played football, too?
Yeah, his brother, I think, Jason Kelce, I want to say.
Jason Kelce,
I actually he played center for the Philadelphia Eagles.
Okay. Yeah,
and they have a podcast together. They're funny guys.
Oh, yeah.
They have a good podcast, good banter.
Yeah, maybe we should get on that one too.
They're like, we'll see who.
Well, investing in Six Flags seems to be an uphill battle. Year to date, the stock is down roughly 45%. The company is losing money and has a market capitalization of $2.6 billion. Travis does have a long-term perspective on all his investments, same way that we do here at Wilsey Asset Management. He is okay investing in a company losing money and hopes it could turn around. Our philosophy at our firm is, we'll not invest in companies that do not have earnings. We're a little more conservative than he is.
And I think it's there's a little bit of typo there. It does not have a long-term perspective. I can't imagine I don't think Travis Kelce has a long-term
No, he
investment.
does.
Does he really?
He does, yes.
Really? No
That's what, yeah, and I
way.
read that, like, yes, he agrees with us. He does have a long-term perspective. He said he's patient, so yeah, he is. He's investing the proper way. He's not trying to get that quick hit. So
I guess he proved me wrong. But
Yeah.
I think it's easy to sit there when you're absorbed and you have that much money and you're marrying Taylor Swift, so you have unlimited money and you can invest in fun things
Yes.
like Six Flags. But again, one benefit that he does have is obviously his name, and I'm sure if him and his fiance Taylor Swift would start showing up at Six Flags, you can bet that they would be all over the news, which give Six Flags some nice free advertising. And we'll see how involved he gets with it. I think he also was in was it American Eagle or Abercrombie? I think he did some shoot with one of those companies as well. And I think him getting with Taylor Swift has really lifted his name as well.
Oh, definitely. I mean, if he wasn't with her, Travis who?
Yeah, exactly.
Yeah. So, yeah, marriage can help a lot. I remember the Kennedys years ago, they did that. You have certain areas that can marry in the family to benefit from the marriage. And I don't think he did it for that reason, but.
Yeah, and it's funny, I still am all into the conspiracies about how the Chiefs always get the best refs, it seems like, because the NFL wanted the Chiefs to prolong their playoffs because viewership is higher when Taylor Swift is at the games. But hey, I'm not going to go there.
Yeah, I guess we won't go there. Let's talk about the big brokerage firms are fighting for your investment accounts, and this is not good. Our investment advisory firm, over the years, has never been a favorite of the big brokerage firms because we generally do 3, maybe 4 trades on average per year. We just don't generate a lot of money for the big Wall Street firms. But the big brokerage firms are now acting like the casinos in Las Vegas and are doing everything they can to get you on their platform. They will give you all kinds of tools and seminars so you'll take higher risk and do more trading. In the meantime, and this bugs me, they're downplaying the risk of trading. They say, oh, yeah, this is great, and they're pushing it because why? The more activity you do, the more they make.
Yeah, and I mean, you can also see, like the casinos in Las Vegas, there are now stories of them giving away free rooms for the big players, so to speak, the big traders, I'll call them, and they are giving you free software and free education on how to trade. Robinhood, who I'm going to say is the biggest abuser of this, obviously the riskiest custodian.
They are almost like
them.
a casino.
Yeah, I mean, it's nuts. I mean, they had invited 1,000 people to Las Vegas, where the casinos are held, and took them go-kart racing and then provided classes with their new trade platform. I mean, Schwab and Fidelity are doing similar types of events to get you to use more of their services. I'm not going to say I haven't read anything that Schwab and Fidelity have done go-kart racing, but I know Schwab has they bought the Thinkorswim platform. I mean, they're definitely not encouraging trading.
And that's just the game now for the big firms. And the thing is, once they get you in the door, they can show you how to use margin debt, which, by the way, had another new record in September of $1.13 trillion, along with option trading and other exciting ways that make you think you can make a lot of money by doing what they tell you to. These guys know what they're talking about. People think. Doesn't that sound like the casinos in Las Vegas that try to get you to hit the gambling tables? That's what they're doing. They're creating this casino thing in Wall Street. I'm not in favor of it.
I don't know. We were talking. Every time I go to Vegas, I win.
I thought, well, you told me you lose all the time.
I do. I mean, I generally cap it at about $100, just and I don't go very often. So, but every time I go and I lose $100, I'm like, I knew this was going to happen. Why did I do it? But as we always say, that's why the casinos in Las Vegas is so nice there.
Yeah.
And I think the same thing with the brokerage firms. I mean, even Robinhood, they're making a good amount of money. How are they affording, to take people go-kart racing, to take 1,000 people there? Well, they're clearly making profits. So, yeah. And again, I don't want to demonize profits. That's not something that I have an issue with. The issue really more becomes maybe that false sense of security in trading that they are teaching to people.
And they're doing it like the casinos to get more revenue based off of you. And this is why the little guy many times in investing doesn't do well, because they get all excited about the hype. And the way we talk about investing sometimes can be boring. Well, buy something, hold it for 3 to 5 years. Like, what? That's kind of boring. I'd rather have someone who can buy, sell. Oh, that's so exciting. But we generate profits, revenue, increase in investments by doing investing properly. But the Wall Street has said doesn't make any money off us. Our clients do.
Yeah, and I mean the thing that you look at here as well is these brokerage firms and kind of encouraging people to trade. I mean, whatever they're doing, it seems to be working, and I'm all for more people investing in the retail investing crowd. I don't have an issue with that concept. The issue that I have problems with is how they invest and the risk that they're taking without realizing that. And what I mean by saying it seems to be working is the percentage of investors who now have self-directed accounts is 33%, which is a big increase from 24% just 5 years ago. And the issue that I have here again is this is kind of what happened in the tech boom.
Yeah.
Retail investing got very big, and then what happened after the bust? Shrunk.
Oh, yeah.
Are we going to see that again? Is it going to get very big, and then you kind of encourage all of this crazy behavior? Because these custodians, these brokerage firms, I guess I'll say instead of custodians, is they're not really teaching people how to invest, but rather more how to gamble and make that quick buck and do the 0-day option trading and the margin debt, which makes them money, but many times maybe not the investor money.
Well, Chase, going back 100 years, it's still the same thing with Wall Street. Wall Street will make some big profits, and the small investors, well, they'll lose most, if not all, their nest egg because of the excitement of what Wall Street did. And the fat cats on Wall Street, they will walk away with their pockets lined with a lot of money. And then all these programs they did and talked about, yeah, the little guy's going to lose their nest egg. I hate to say it.
I remember this was years ago. I mean, this is nothing new, but I remember we had a client come in and it was this trading software that, when the green button flashed, you bought. And when it was red, you sold. If it was that easy, everybody would be not just millionaires, everybody would be billionaires, because then you could leverage up, you could take on margin, and you'd always win. That's not how it works. And I'd love to sit here and tell you that you could make 20% a year. If that was the case, everybody would be extremely wealthy, and that's not how it pans out. That's why when you look at just owning businesses, and we tell people, if we could do 8 to 10%, we're thrilled with that. People look at us and say, you're crazy. I could do way more. Long term, that's how you lose. And you might win for a few years, but like when I started in my blackjack days, I won like the first 6 months. I'm like,
that's right. You would make a lot of money playing
blackjack. I was in college. I made thousands of dollars. And I'm like, this is great. Today, I'm down probably $1,000 on my gambling career. Just because you win for a period of time, it might be 6 months, it might be 3 years, it might be 5 years. You don't want that short-term winning. You need to win over 20, 30, 40 years.
Lifetime.
And this trading is not how you're going to get there. It's by buying good businesses at good prices.
Yeah, and that's what people don't realize. It's not 3 to 5 years is not a long time. You are investing for your lifetime, which is hopefully 50, 60 years that you live to be in your 80s, 90s. And if you think you did well for 3 to 5 years, yeah, congratulations. But as Chase just said, he did great with blackjack for a while, made thousands of dollars. All of a sudden, it doesn't work any longer. What does work is investing in companies at good prices and let that company pay you dividends and so forth. That's how Warren Buffett became the most famous investor in the world. But all this information does come from our website, from our newsletter. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of other topics there that you can get there as well. Again, smartinvesting2000.com. Let's move on to our first company. Coca-Cola is what we're talking about. Now, they're in the beverage, non-alcoholic, not much short here, 0.8%. Institutional ownership is 66%. They have a PE ratio of 22.8, which is below the industry at 26.3. Price of sales are expensive, 6.2 versus 3. Price to book value, 9.5, also expensive compared to the industry at 5.8. Again, valuation ratios, you want them lower than the industry average. While price to cash flow is very expensive, 39.2 versus 21.2. And the PEG ratio does look good, though. That's your price earnings growth, what you're paying for the future growth going forward, 2.7 versus 17.4. So Coke did win there. Now, last year, Coke has done really well. This surprised me. Their earnings are up 25.3%. The industry was down 14.4%. Could have been a low earnings last year. They're building on a lower number, but you got to check that to see what's going on there. Sales are up only 2.8%. Industry was down 8.7%. 5-year earnings per share growth rate for the analysts on Coke is 8.9 versus 7.3. Now, they do pay a decent dividend, 3%. Only use 66% earnings to pay that out. That's a big positive there. Looking at the balance sheet, current ratio 1.2 versus 1.3. Debt to equity is kind of high for Coke at at 1.5 versus 0.8. I think that's always been the case because it is the big Coke company, I guess I'll say. But 1.5 debt to equity, that's too much for us. We don't like it that high. Intangible assets, this is another bad part, 30.3%. That's pretty high. Almost a third of their assets are intangible, which means they are not real. You can't touch them. Net profit margin, very good, 27.3 versus 11.2. Return on equity, extremely good, 41.7. Free cash flow for Coke is $5.5 billion. That is above the industry of $4 billion. And you like that cash flow, that's how they can pay those nice dividends with Coke. And Coke has just been like a steady grower over time. But is it time to buy it based on what we got going forward here, Chase?
Yeah, well, current price here for the Coca-Cola company, again, ticker symbol KO, it's $68.90. 52-week range, the low here is $60.62, and the high $74.38. Over the last year, it's up about 4.5%. Year to date, up close to 10. 5-year return, not super exciting, but okay, up 40%, and 10 years of about 64%. I am curious, though. I know yours includes dividend. What's the 10-year return of dividends?
Oh, yeah, you said 64% for the 10-year, including dividends, 120.6%. So that makes it. That's why we like dividends. They can make a big difference on your returns.
Yeah, and I kind of have a thought on that, but I'm going to give this target sell price here first. Sure. If you look at December 2026, estimated earnings per share here, $3.22, gives us a target sell price of $53.45. So unfortunately below the current price, but I'm going to say fundamentally, Coca-Cola is a type of business that we like to buy. I mean, earnings are growing around that mid to high single-digit range. So maybe you're growing at, let's say, 5 to 7%, but you're getting that 3% dividend that has also increased. Mm-hmm. That is how you can make good money without, I'm going to say, taking on too much risk. You grow earnings at, I'm going to make it easy on me, 7% a year, and you get a 3% dividend. Well, shoot, if you maintain that same multiple, you're making 10%. That's a good return. The problem with Coca-Cola, though, is that valuation is a little bit too high for us to have any interest in it.
Yeah, and it's something that you probably want to look at. There could be pullbacks because of news that doesn't really affect them, drops 10, maybe 15%. That could be a buying opportunity because the earnings, again, 23 analysts. I've never seen earnings so tight. The low is 315, the high is 329. That's a difference of less than 15 cents. And the earnings have pretty much stayed the same over the last 90 days. I mean, it was 321 90 days ago. Today, 322. Coke has just been a steady goer for year after year after year. The time to buy Coke is when something happens to the overall market and they're dragged down with the market. That's when you want to buy it.
I mean, hey, Warren Buffett, one of his largest holdings, I know he's loved not just the stock, but also the product for a long time.
He loves his Coke. All right, so we're going to take a quick break. When we come back, we got Harrison talking about when does a solar system make sense? And we also got Capital One, Qualcomm, and Knight Swift coming up for the company. Stay with us. You're listening to Smart Investing Show with Brent and Chase. All righty. Welcome back to Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. With me and Chase is Harrison Johnson, our financial planner. He's a CFP. Harrison, this is something that I don't want to say I'm surprised about it because I know that the credits are leaving, but maybe that's why it's so important to talk about is when does a solar system make sense? Because we think, oh yeah, no matter what, it makes sense. And maybe that's not the case.
It's definitely not the case. Sometimes it does, sometimes it doesn't. But I think a lot of people out there, when it comes to reducing their monthly bill, they almost don't care how much it's going to cost up front. Yeah, I'm going to install solar no matter what the cost, and then that's going to save me $100 a month or $500 a month or whatever it is. How much is it costing to get that? And so with solar, you can buy solar, you can lease solar, or you can do nothing. Doing nothing is an option as well, and sometimes that's the right thing to do. Buying potentially makes sense, if you're using a lot of electricity, obviously, but like myself, I don't use a lot of electricity at my house, so solar wouldn't really be that helpful for me. But if your bill is $500, $1,000, $1,500 a month in electricity, some type of solar system might make sense. So you have to be using a lot of electricity. This is kind of an important time because the 30% federal tax credit is expiring at the end of the year. So this is kind of the last time to get that 30% credit. When you buy solar, if you finance that with a mortgage or a HELOC, you can write off the interest. So that might give you some tax benefits on the itemized side if you're able to itemize. So, and that also means you don't have to shell out, $50,000, $70,000 up front if you're able to finance it. And that means hopefully the loan payment that you have then is less than what the savings were for what you were paying for the electricity. So it's just an immediate benefit starting out. When you put a solar system on your house, it does increase the value, but maybe not potentially as much as the cost of the system, which is why it's better if you're then going to be in the house for a long time so you can recoup that investment of installing the system. And then lastly, in California, if you buy a solar system, you almost need to have a battery. A couple years ago, California changed the way the grid works with solar, and it's kind of crazy because if you have a solar system, but if you don't have a battery, basically what happens is during the day, when the sun is out, you're generating power and you're selling that to the grid. And the grid buys that from you or gives you credits based on essentially the value of the power at that time. So since you would be selling power from your solar panels to the grid at the same time that everybody else is selling power to the grid, there's this huge supply of power at that time of day. And also, everybody is, at work or out and about doing stuff, so there's not a lot of demand. So when you sell power to the grid, you get almost nothing for it. And then at nighttime, when you come home and you actually need the power, if you don't have a battery reserve, then you have to buy it from the grid at a price that's 4, 5 times, 6 times more than what you sold it to the grid, earlier that day. So having a battery allows you to generate the power during the day and then use it at night when power is really most expensive. But batteries to get are expensive. It didn't used to be like that. So now that kind of added an extra cost if you're going to go and buy a system. So if you're not going to be in the house for a long time, or if that doesn't necessarily make sense, then leasing could make sense. There's not an initial upfront expenditure or investment. It's just now you're leasing these panels, and that lease payment generally is less than what you were paying for electricity before. So you might save $100, $200 a month without any initial investment required. But with that, it doesn't increase the value of your home generally. There's no tax credit that you get involved, and it can present a problem if you ever go to sell the house because the buyer essentially has to qualify and assume that that lease agreement for the solar panels. So in some cases, it's best to do nothing if you're not planning on being in the house for a long time, or if you don't use a lot of electricity, then doing nothing might be the right thing to do, actually.
And maybe there's something, I got a bunch of thoughts in my head here, but maybe there's something that you can compute out saying, okay, if you're in the house for 7 years, that's your break even. So that's something that maybe you can do to say.
It's something that I do because I've got a lot of people that have done solar, and every situation is different based on, how much power they use, how much surface area they have on their roof, and how much power they could generate, what the cost of the system for that house, given the demand that they're going to be using is, which influences the credit they're going to get, what they can qualify as far as financing and how much equity they have in their house and what, terms like that are. So there's, it's not like, okay, well, 7 years is the break even. For some person, it might be a lot sooner than that. For some person, it might be longer than that, which means they probably wouldn't want to do it. So it depends on the situation. But, for some people, buying is better. Some people, leasing is better. Some people, nothing is better.
And the other thing, too, that I look at doing, there's other things you can do, like LED lighting. It's very cheap now. Replace all your lights with LED. Your washing machine, your dishwasher, many times have timers. Well, find out when the off-peak hours are. I think it's like midnight or something.
4 to 9 is usually when stuff is most expensive. So midnight to 6 a.m. is usually the cheapest time, or weekends a lot of time up until like 2 in the afternoon is cheap. So all, washing clothes, dishwasher, all of that extra stuff really should be done like Saturday, Sunday before 2 o'clock, and that's the cheapest.
Well, and again, our dishwasher has a 6-hour timer. So if you want to start at 1 o'clock in the morning, you can. So there's things you can do that may be a lot less expensive than buying a whole solar system if you don't have LED lighting in your house. And I bought my house. It's leased. The solar systems, I'm not really thrilled with it because I hate the company. They keep, your payment's due in 5 days. Like, I know it. Just leave me alone. Sign up for automatic payments. I don't want to sign up for they're very annoying.
I was going to say the big thing with the battery, I remember looking at this, probably sometime last year, but I remember the state of California, we were generating too much power. So not only did we sell the power to Arizona, we paid Arizona to take the power from
I
us.
remember that.
And it's like, gosh, if we could just figure out the grid, we wouldn't need this stupid battery. And it's like, it just drives up the cost of solar. And it's like, they want everybody to have solar, but we haven't figured out the infrastructure. So now I have to buy this battery, which I think the batteries are.
It's expensive.
Yeah.
It's, I mean,
30 grand comes to my head. Does that sound right?
Depending on
You
how
might
many.
need two batteries.
You might need two batteries. So yeah, I mean, it can be $1,000.
Because I was looking at solar, and the quote I had to maintain the power that I'd generate and use would I need two batteries.
Really? Your house is what?
2,300 square feet.
2,300 square feet. Wow. So I might need 3 or 4 batteries.
Yeah, definitely. Definitely. But again, I mean, those things are expensive. Now, the batteries also qualify for that 30% credit, so you get a help out on that, but that's ending this year. So, you know, buying a solar system is about to get a whole lot more expensive in 2 months. And I mean, even right now, I'm sure that there's a bunch of solar companies that are booked out because a lot of people are trying to do this before the end of the year. So it's going to get more expensive.
Well, I almost do wonder because I've wondered this with EVs too, when that credit goes away, well, that's going to distort the market.
Yeah.
Because there's an artificial
Yeah.
demand right now.
Right.
So you might see prices fall. Now, are they going to fall to the break even of your 30% credit? Probably not, but you're probably not going to, let's say I'm going to use the number $70,000. Well, it's probably not going to fall 30% next year below 70,000, but it might fall 10, 15%.
I definitely think that's true because everybody who wants to do it is doing it right now. So that means, you know, only people that buy new houses that don't have solar or, you know, whatever, they're going to be in the market potentially to do it, which, will decrease the demand substantially.
So Harrison, you are a fee-based planner. So if somebody calls up and say, hey, I'm thinking about buying a solar system. Do you work the numbers? Do you go through this stuff with them?
Absolutely. Go through the numbers and say, yes, you should buy it, or yes, you should lease it. And then if you are going to buy it, this is the best way to finance it, or, you know, it's best not to do it at all. Another thing, you know, you get the credit. So I had somebody earlier this year who installed a solar system, and now we can basically assume that they're going to have this large federal tax credit. So we basically stopped withholdings on their payroll throughout the year. So now instead of getting, you know, a large, you know, refund at the beginning of next year, now they're basically getting that tax benefit all of this year. So there's different things you can do to, you know, make sure that it makes sense. And then, you know, even if it does make sense, there's different ways of going about doing it, and you want to make it as efficient as you can.
Maybe take that cash flow, put it into your 401k, maybe get another tax deduction.
Actually, that's what we did. Yeah.
Okay, there you go. All right. Well, Harrison, thank you very much. Again, that is Harrison Johnson. He is our financial planner. He is a CFP. If you want to talk to him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You can send him an email, and you can talk to him that way and get that free consultation as well if you want to. All right. You ready to do another company?
Let's do it.
Let's do Capital One. Capital One Financial. Symbol is COF. And it says credit services industry. I think that's kind of changing. They seem to be doing more banking than just credit services. But that's
they do that, but they also bought Discover.
Yeah.
So, you know, they are kind of banking, credit services, and then also trying to compete more in that realm of Visa, MasterCard, where they also benefit from that swipe fee.
All right. Well, let's see. Not much on the short side. 1.1%. Institutional owned, 88%. Ooh, I was thinking this might be a good buy, but not a good start here. PE ratio 75 versus 27.6 for the industry. Price of sales 2.2 versus 5.1. Price to book value 1.2 versus 5. That is good. And then price to cash flow also looks good at 5.4 versus 15.1. And there is no PEG ratio, unfortunately, for Capital One Financial. Now, their earnings over the last year, and this is a strange number, maybe because of the situation with Discover, something's going on here. Earnings over the last year are down 96.6%, while the industry was up 1.4%. However, sales for Capital One were up 11.3%, just slightly ahead of the industry at 11%. And the 5-year earnings per share growth estimate is way off. It's a negative 165, I think, because of all the movements with the acquisition and so forth. Numbers just aren't working out at this point in time. They do pay a 1.1% dividend. Again, payout ratio 685%. Again, I think because the buyout is what I'm projecting here.
And I did look at this. Capital One and Discover, the merger officially finalized on May 18th, 2025. Since then, the Capital One has said that Discover has been fully acquired and is now part of their company. So I'm going to speculate here, and I'll kind of get into the earnings, but I'm going to speculate that a lot of those earnings distortions is because of this merger.
That's what I'm guessing as well. So they are a financial company. Look on the balance sheet. They don't have a current ratio because financial companies don't, but the debt to equity is very good, 0.5. That compares with the industry at 1.5. We do see a net profit margin for Capital One of only 0. They don't have a net profit margin at all. The industry is at 19.3. Return on equity is a negative 0.3 versus a positive 41. Return on invested capital 8.8. Let me see. Free cash flow looks very good though. 18.2 billion versus 16.6 billion for the industry. I think it's very hard to look at investing in a company when they go through such a major acquisition. This may be something we may have to wait for next year, new numbers, because unless you have something exciting on your side, I just can't justify buying this company.
Yeah, I mean, kind of give away a little bit. The numbers look pretty exciting actually going forward.
Okay.
Current price here for Capital One Financial, again, their ticker symbol is COF. $219.99, 52-week range, the low here, $143.22, and the high, $232.45. Year to date, it's been a good performer, up about 23%. Looking at the longer term, 5 years, actually up about 190%, and the 10-year return up 168%. So, it's done pretty well over those different time spans. And what I'm talking about is going forward, that valuation looks attractive. You got to December 2026, estimated earnings per share here, $20.87. Gives you a target sell price of $346.44. So that's a forward PE right around 10.5 times.
Yeah, I looked at that number as well. Those estimates have come up the last 90 days. They were 1978. Now I showed 2075. I think you said 2080. I believe this acquisition of Discover is going to be a great thing for Capital One. I think you'll just see their earnings climb dramatically as we're seeing here.
Well, I mean, it kind of almost enables them to compete more against like an American Express, right? Because American Express doesn't use Visa and MasterCard. They have their own interchange network, where Discover has their own as well. But Capital One has more of a brand name than Discover did. When they announced that deal, I thought that was a huge win for Capital One. And I'll tell you from a personal side is we actually used Capital One on the business level, and I've been just blown away with them as a business taking care of their customers, which I think bodes well for the company long term as well.
Yeah, and I get we get 2% cash back, no issues. Yeah, we'll send you a check. I mean, they're such a great company to work with. I'll say this to our listeners: we actually looked at buying this a year or two ago, and we drug our feet, and it's just like, doggone it, why do we?
I think it honestly might have been like 2 years ago.
2 years ago.
I mean, it was, yeah.
And I think what it was...
It was pre-Discover.
Pre-Discover, yeah, oh, definitely. But I think what it was we already had two big financial companies in the portfolio, and we were not over-concentrated. But, yeah, it's a great company. And based on what you're saying, still could be a buy, but I think I'd rather be patient a little bit. And
I mean, things are expensive. I'm not jumping for joy over Capital One, but yeah, I mean, a broader based pullback. I think Capital One is a good brand, a good company, well run, good valuations. I think on a pullback, this would definitely be something of interest to add to.
And actually, patience does pay off. I mean, we just bought a company this past week, a huge investment we did in it. But look at that company. I'm going to say at least 2 years I wanted to buy that company. I've been watching it fall. I mean, sometimes when it comes to investing, you've got to be patient. Don't just pull the trigger. That's what those Wall Street firms want you to do, to pull it like, oh, made a mistake, sell it, buy something else.
Well, the interesting thing is, as you said, we missed Capital One, right?
Yeah.
Unfortunate.
Yep.
But also we were patient on this other company, and that benefited. I mean, that's why Warren Buffett says, investing is a zero-strike game. You don't have to swing at every pitch that comes, right? But you also have to have the understanding you're going to miss things when you're patient. Yeah. But just because you miss something doesn't mean something else isn't going to go on sale 6 months, next year, 2 years. There's going to be other great businesses that you can find when you are investing properly.
I've had people say, oh, you missed that one, you missed that one.
I miss something every day.
Yeah, I miss something every day. I go, but what's important is not just that one, it's your overall portfolio. Yeah. Because you might have hit a home run on one, but your rest of the money has been sitting in cash, earning very little. you've got to look at the whole portfolio. Portfolio analysis is very important to make sure you do that well. So, let's see. What are we going to do next here? You want to do, I guess, Qualcomm is what we're going to do next. And Qualcomm, Qualcomm, I've always been in favor of this company, like a lot of people. It's a San Diego-based company, so I always want them to do well. We've had our concerns on it, but we'll go over some numbers, talk about what we're seeing here. They are in the semiconductor industry, only 2.5% short on the float side, 81% institutional owned. PE ratio looking pretty good, 17.5 versus 56. We do see price to sales 4.7 versus 15.2. Price to book value also good, 7.2 versus 12.7. And price to cash flow 16 versus 41.2. No PEG ratio, unfortunately. I would like to see a PEG ratio, but it's just not there. Over the last year, their earnings are up 15.9%. That sounds very good, but the industry was up 55%. Sales for Qualcomm up 11%, also very good, but the industry up 57.3%. Now, the 5-year growth rate on the earnings from the analysts for Qualcomm is a negative 4.6%. The industry is a positive 42.6%. We do say they pay a decent dividend, 2%, using 33% of their earnings to pay that out. And then look at the balance sheet here. We got a current ratio of 3.2 versus 3.3, so good liquidity. Debt to equity, not bad at all, 0.5 versus 0.3. We do see a net profit margin for Qualcomm of 26.8 versus 24.5. That's a positive. Return on equity is 42.6 versus 58.8. And then we have free cash flow, $11.6 billion. A lot of money. But the industry's at $43.7 billion, so they're kind of underperforming there on their cash flow side.
Well, I mean, shoot, that probably includes NVIDIA. And NVIDIA, right or wrong, I mean, they are a great business. I say right or wrong. Expensive or not,
right.
It's a great business. And, the thing you look at is NVIDIA's got now a $5 trillion market cap. Qualcomm's got a $190 billion market cap, so NVIDIA's free cash flow better be a heck of a lot better than Qualcomm's. But, this company was interesting. The reason we wanted to pull this out was, they had a big surge this past week. They actually made the announcement that they were going to release new artificial intelligence. There's that word, AI accelerator chips to target the AI inference market. The announcement marks a shift from Qualcomm, which has so far focused on semiconductors for, again, that wireless connectivity and mobile devices and not massive data centers. Now with these new chips, Qualcomm is going to be competing against NVIDIA and AMD's GPU offerings and adding competition to that AI semiconductor market. It looks like the AI 200, which is a Qualcomm chip, will go on sale in 2026, and then the AI 250 is planned for 2027. So concern here is it went up a ton.
Yep.
But there is no guarantee that they effectively take on NVIDIA, which obviously has a great product.
I mean, you're the little guy coming in and take on the big guy. And I think when that day, I think the stock was up, Qualcomm was up, I think, 20%. Normally, when you get competition on the market, the other players drop. Well, AMD and NVIDIA went up that day. So you never want to get into a competition war, especially with the big players. I don't know why that. And again, this reminds me of the .com and bust. I got more numbers to cover. But if you said .com, your stock went up. Now, if you say AI, stock goes up.
Yeah, without any fundamentals behind it. There's no fundamental news on this. It's just like, we're going to do this. Oh, cool. Yeah, we're going to buy it up 20%, maybe like a 4 or 5% bump. I'd understand because there is some opportunity there, but a 20% bump just seems outrageous. And I think the market kind of agrees because the current price here for a Qualcomm is now $180.90. The high that it hit on Monday was $205.95. Oh, wow. So it's down about 12% from that high that it hit just on Monday. The 52-week low, though, if you bought then, it was $120.80. So you've done well from the low. But again, if you got sucked into the hype on Monday, you are now down likely on the week. It's, again, why trading doesn't make sense. Going forward, though, for Qualcomm, you go to September 2026, estimated earnings per share here, $12.08. It gives us a target sell price of $200.53. Forward PE still around 14.5 times, 14.5, 15 times. So, I mean, it's not overly pricey like a lot of the other tech names, but I wouldn't say it's a great value at these levels either.
Yeah, and there's other issues with Qualcomm. I mean, they do have, China, big part of the market. China came out and said they can't do something. I forget what it was, but China said, nope, can't do that. We know that next year they lose, I think, $2.7 billion.
I think it's 2027.
2027?
I believe so.
Okay, I was going to say, I thought it was late 2026, but we'll say another year from now, somewhere around another year. That's still not good to know you're going to lose almost $3 billion of revenue. I mean,
From Apple.
Yeah, from Apple.
Yeah.
But even with that, I mean, still, it's just like, you look at, okay, so now they're coming out with these AI chips. Maybe it works. Maybe it's great. I think with Qualcomm, they're a great company. I think they can make it work. But will it really add that much revenue to the situation? I don't know, because now that's a third big player in the AI chip industry, and maybe they can't make it.
Yeah, and it is the Apple Qualcomm modem supply agreement is set to end March 2027.
Okay.
And, this is kind of going out there a little bit, but again, patience is important. We were actually looking at Qualcomm earlier this year, and again, you might miss it, but I kind of would want to wait until this deal ends, and you might see that stock go higher. But I think that is, as you said, a huge risk, and they have different product lines and business lines to hopefully displace that growth. But that's a lot of growth that you got to have to displace a potential big relationship like you have with Apple. So I think, to be fully transparent, is we looked at Qualcomm earlier this year and we held off on it because of the China risk and because of this Apple risk.
Yeah, I mean, I remember the number said yes, and we were so excited. Like, yes, I think we were going to buy it below 140. Like, the number said yes, and then we saw that. And again, right now with China, they're a big part of their business. They're not a friendly trader, and I'm sorry. I want to say I thought the number says 52% of business comes from China, which not a favorable partner to play with. So
yeah, and the chips are always very interesting because it's not like they're selling the chips to China, but they're made in China, and the U.S. buys them from China. So then it shows up as a Chinese sale. And yeah, here it is. China accounts for approximately 46% of its total revenue.
Yeah, that's not good. I'm sorry. And I want to like it. I want to be part of it, but I just got to be logical here. We'll see how this thing plays out. Maybe it plays out great, but right now, not so much.
It's a risk.
Big risk.
I'm trying to reduce risk, and that's a big risk that
Yeah.
I don't know if I'm comfortable with.
Yeah. So let's move on. Gosh, we're not out of time here, but let's move on to Knight Swift. They are a trucking company. I thought this would be good because maybe see something in the economy here. Their symbol is KNX, 6.2% short on the float, not too bad. PE ratio, not very good, 51.3. That's above the industry at 42.5. Price to sales, 1 versus 1.1. Price to book value, 1 versus 24. That's a positive. Price to cash flow, 9 versus 11.9. They do have a PEG ratio of 2.4 versus 22.5. Now, earnings over last year of 282% when the industry was down 21.9. We do see sales for Knight increase by, they were flat, no increase, but the industry was up 3.4. The analysts give it a 5-year earnings per share growth rate of 13.2 for Knight versus 6.9 for the industry. Now, they do pay a 1.6% dividend using 80% of the earnings to pay that out. Not that great, I will say. We do see on the balance sheet, current ratio 1.3, same as the industry. Debt to equity 0.5 versus 0.7. We do see a net profit margin 1.9 versus 3.2. Return on equity very bad 2. We like to see it around 15. And then we have free cash flow. They actually have a negative cash flow of 62. I guess that's going to be $1 million versus the industry at 386 million positive. So not looking good. I do worry a little bit with the economy staying where it is, that trucking companies could have some problems. What do you see going forward, Chase?
Yeah, so current price here for Knight Swift Transportation, their ticker symbol KNX, is $45.12, 52-week range here. The low is $36.69 and the high $61.51. So a decent-sized pullback there from the high. Year to date, the stock has struggled down about 15%, obviously, when the broader base market is up. Going forward, though, I mean, the valuation is still, I'm going to say, a little bit off. You go out to December 2026, estimated earnings per share here, $2.07. Gives you a target sell price of $34.36. So, I mean, it's still trading at 21 times those future earnings. And the interesting thing is the earnings growth. I mean, this year, you're looking for earnings growth at 26%. Next year, 54%. And again, less analysts, but 2027, they're looking for 48% growth. That would push you down to a forward multiple of about 14 times. So who knows? Maybe if you get more of a pullback and, things still stabilize, you could look at buying this maybe at the beginning of next year. The valuations might come into a better play there.
And actually, the earnings going out to December 2026, they were down almost 15%. They were 90 days ago 243, now at 207, as you said, and that's a big drop. So, again, we don't think we're going to recession, a slowdown in the economy, but there's a slowing down of the growth of the economy, which can affect trucking companies.
I mean, this is a type of business you want to buy in a recession.
Yes.
Because the numbers will be low, and then you'll be coming out of that recession, and then that's where you could really find this on a great value at that time. So I think right now it's maybe too early to buy a business of this nature. And again, like I said before, you might miss it, but I think being patient here with a company like Knight Swift could pay big dividends long term.
And I think trucking companies and train companies buy during a recession. Yeah. All right, well, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only. It should not be used as investment advice. I'd like to discuss in more detail your investment needs, have other investment questions. Feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. And when you're there, sign up for the newsletter, look at past podcasts, a lot of great educational information there. Thanks for listening to the Smart Investing Show with Brent Chase. We'll be back next week.